Good morning and welcome to another segment of Sarah's Opening Bell. I'm your host, Sarah Bryant, and I'm here to help you make sense of the markets. Now, when we say the markets, what exactly are we referring to? So there's the stock market, which is the network of exchanges where you trade stocks and other securities. And then there are the markets, the stock indices that financial professionals and investors rely on to measure overall stock market performance. So a market index is a cross-section of the market that provides an estimate as to how the market as a whole is doing. Indexes are helpful in that they provide investors with a simple snapshot of a large market sector without having to examine every single asset in that index. The three most popular indexes for tracking the performance of the U.S. market are the Dow Jones Industrial Average, S&P 500, and the Nasdaq Composite. The Dow Jones Industrial Average, also referred to as the Dow, is the oldest U.S. stock index and tracks 30 large, publicly owned blue chip companies trading on the New York Stock Exchange and Nasdaq. The Dow Jones is named after Charles Dow, who created the index in 1896, along with his business partner Edward Jones, and is considered to be a gauge of the broader U.S. economy, and it is one of the most watched stock market indices in the world. The S&P 500 index was launched in 1957 by the credit rating agency Standard & Poor's and tracks about 500 of the leading publicly traded companies in the United States. The S&P is a float weighting index, meaning that the market capitalizations of the companies in the index are adjusted based on the number of shares that are available for public trading. So market capitalization, or market cap, is the total dollar value of all outstanding shares of a company at the current market price. The Nasdaq Composite Index tracks more than 2,500 stocks listed on the Nasdaq Stock Exchange. The Nasdaq Composite is comprised of both domestic and international companies and is heavily weighed towards the technology sector. Now, since all three indexes include some of the most significant U.S. stocks, they can serve as a good representation of the overall U.S. stock market. Now, investors may choose to build a portfolio that exposes them to several indices through an index fund. Now, index funds is a professionally managed collection of stocks, bonds, or other investments that tries to match the returns of a specific index, like the S&P 500. And index funds are usually mutual funds or exchange-traded funds or ETFs. Some funds buy all the securities in the index, while others just simply pick a sample. Index funds can offer instant diversification for a portfolio, which helps to reduce risk. They also tend to be low-cost investment options, which is a big reason why they're popular with investors. However, keep in mind that an index fund will never perform better than the market index that it tracks. So if you're still considering ways to diversify your SMG portfolio, an index fund may be an easy way to do just that. Now let's get started because the markets are now open.